Welcome to our video series, Industry Viewpoints, brought to you by the American Bankruptcy Institute. Each segment will feature an expert providing views on the current state of a particular industry with a focus on what lies ahead. My guest on this edition is Robin Russell, the Deputy Managing Partner of Hunton, Andrews & Kurth. Before that, Robin was the Managing Partner for the Houston office of Andrews & Kurth, where for 15 years she was the national head of the firm's bankruptcy and reorganization practice. Here at ABI's annual spring meeting in Washington, D.C., Robin was on the panel covering the collapse of Silicon Valley Bank and discussing what went wrong and what happens next. For the next few minutes, we'll be talking with Robin about whether we averted a banking crisis and whether there might be one still to come in the future. So, Robin, speaking of Silicon Valley Bank, I must admit, having followed it in the newspapers, I was astonished, just floored by how quickly the bank collapsed. I mean, 24, 48 hours, one of the most prominent banks in the country was gone. And it scared the daylights out of me at the time, but how did that happen? Why did it happen?
Well, why did it happen focuses on the change in interest rates so quickly and the fear that was created through social media in the stability of the bank. So the run happened quickly because of two things in my mind. Online banking allowed people to transfer money out of the bank very quickly. $140 billion plus went out of the bank within less than 48 hours.
Goodness gracious.
And that was precipitated by social media and the fear that was created. Very few banks in this country could survive that kind of run on the bank. And in years past, people would line up around the bank. Well, we don't have to do that anymore. We can do it on our phones. And liquidity was needed because interest rates had changed. Some of the investments that the bank was holding, which if they had held them to maturity, would have been just fine.
Yeah, all you had to do was survive a run for 5 years.
Right,
you're
exactly.
Okay, yeah.
But they had to sell them at a significant loss in order to create the liquidity, and then at some point it just ran out. And this bank was one of the few that was actually closed in the middle of the day. Typically, the FDIC closes a bank after the close of business.
You mean to tell me it was so god-awful that they couldn't wait until the evening?
They couldn't wait until close of business. And
goodness.
People who had sweep programs in place, that's what created the problem, is that a lot of those transactions were not completed yet. And so a lot of money went out very quickly.
Well, you know, you paint a very frightening picture, especially by what you said to the effect of that there are few banks that could survive that kind of withdrawals within a short period of time.
Yes.
I wonder where you hide. Maybe I buy gold and put it under my mattress, right?
Well, this has certainly caused depositors, particularly corporate depositors who have lots of operating cash on hand, to assess their programs. And you can set up programs at banks to protect a lot more than $250,000 through the sweep programs, buying treasuries overnight, that type of thing.
Yeah.
But for the average person, it certainly gives them pause about what kind of due diligence do they need to do on their banks in the future.
Well, you know, from what you're saying, it sounds as though this is not going to change. We're going to have to live with this threat forever because of social media. Is that
Well,
how you see it?
and the technology that allows money to be drawn out of a bank so quickly. And it's a snowball effect.
Yeah.
So yes, I don't think that's going anywhere.
Well, is there anything that regulation could do to prevent another overnight disaster like Silicon Valley?
Well, several things have been thrown out by pundits, by commentators. One is to insure all deposits. And that is problematic because it will ultimately increase the cost to us because premiums will have to be paid by the banks, higher premiums to the FDIC to insure our assessments, to insure deposits.
Well, wouldn't that create a moral risk too? That
it absolutely would.
Yeah.
And it's been said capitalism without bankruptcy is like heaven without hell, right? We have to have some consequence to this. And a bank that has no risk may lend in ways that are not safe and sound. And we need to weed out the bad banks. And so having completely risk-free your deposit, I don't think will ultimately work for a variety of reasons. It would basically make a bank a public utility.
Well, I think one of the things that the Silicon Valley failure demonstrated was that even with regulation, supervision, oversight by the FDIC and other government agencies, the bank management can still almost innocently make mistakes that lead to the demise of the bank. I mean, this was one of the most highly praised banks in the country, and it just blew up overnight. Astonishing.
And we do not know all the causes of the failure, nor will we for quite some time. Although May 1st is the day that the report is supposed to come out. But I think that that will be just the first piece of the puzzle.
Yeah, and then on the other side of the fence, had regulators acted more proactively, say a year ago, clamped down on the bank's growth, I suspect people would have screamed and hollered, "Oh, you're harming a wonderful growing business." Of course, we'd never known that it stopped a failure, but I guess that's the difficulty with regulation is if it's effective, it may also generate opposition. Well, listen, is there something that could be done? I mean, for instance, on Wall Street, and I forget what the triggers are, where if a stock falls a certain percentage, there's a trading halt. Could something like that be used with the banking industry?
Well, remember, these deposits are demand deposits. They're to be paid on demand. And halting a deposit withdrawal would be more terrifying for people, I think, if they knew that the FDIC could do that.
Oh, well, so much for that idea. Well, I'll tell you something that I've heard about but really know nothing about is the notion of the source of strength doctrine.
Yes. So
tell me about this. How does this play with bank survival?
Well, we're here at a bankruptcy conference, and so as a first step, banks cannot file bankruptcy. A bank cannot. They're one of the few entities that are ineligible under the bankruptcy code. But if they are owned by a bank holding company, as they often are when the bank holding company is allowed to have not only banks but non-bank subsidiaries, when the holding company is in distress, they are allowed to file a Chapter 11. For as long as I can remember, in the banking regulations, there has been a provision that a holding company is to act as a source of strength to its bank subsidiaries. And that has been the subject of a lot of litigation in bankruptcy court for bank holding companies over what exactly that means and what it obligates the holding company to do in bankruptcy. And does it create a claim by the FDIC against the holding company in bankruptcy? There was codification in Dodd-Frank, but still there's a lack of clarity over what exactly that means. And so we're waiting to see in Silicon Valley Bank whether the FDIC, who is holding about $2 billion of the holding company, that's what they had on deposit there, will the FDIC claim a set-off to that money based on a source of strength theory, that the holding company should have acted as a source of strength, and therefore the FDIC can hold on to that money.
Wow. Nothing like a lack of clarity to
there's actually,
it creates opportunity for hedge funds in buying debt, doesn't it?
And for bankruptcy lawyers as well,
that's
right?
right.
There's actually a special provision in the Bankruptcy Code, 365.0, that went into effect in the wake of the bank crisis in the 80s and early 90s. And it provides that if the holding company has a obligation to maintain the capital of a bank, that obligation to the regulatory agency is automatically assumed in the Chapter 11 of the holding company.
So how does this get created, or what is it that would be this automatic assumption?
So this is the subject of litigation, and I think it may be the subject of more litigation in Silicon Valley Bank, and that is, what does it take to have an enforceable obligation against the Chapter 11 debtor like this? Because to act as a source of strength and provide capital, we could be talking hundreds of billions of dollars, which would dwarf any other claim against a holding company in bankruptcy. And so we know from one case that where there was an actual performance guarantee of a capital restoration plan for a bank, that the holding company was deemed to have that obligation. That was an actual guarantee. But beyond that, there is a lot of gray area. What is going to constitute that financial obligation to support this?
It seems to me like Congress did something that looks good on paper, but it lacks sufficient detail to reliably provide relief. But perhaps if it did, it might really enrage people who invest in bank holding companies, because it certainly puts a cloud over the value of their investments of debt and equity in a holding company. So I guess it's a double-edged sword. Wow.
Yes, for the holding company issuing debt, and often that is how they raise capital to downstream into their bank subsidiaries. They have that risk now to disclose that they have a guarantee which could take priority over their bondholders.
Well, I tell you, Robin, this is very interesting and enlightening, and frankly, a little frightening.
Right. Yes.
But you have convinced me, and that is, I'm going to be very careful that among my banks and my brokers, I don't too much exceed the insurance limits, because I could, instead of being a commentator, end up being a creditor, which I'm not the least bit interested in doing. So I thank you very much for this very enlightening discussion. And at the same time, we thank you in the audience for tuning in. In the Industry Viewpoints series in upcoming days and weeks, we will be talking with other experts about the future of industries that are affected by our turbulent economic times. Until then, be well, stay safe, and a good day.